So in today's video, what I want to do is share with you some of the things that I did when I first started buying equity, when I first started getting involved in the stock markets. Now, the reason why I think this is really important is because it can be incredibly daunting, especially for a beginner, when you first look at that amazing amount of information which is coming in, the huge number of decisions you have to make, and of course the complexity of potentially managing an equity portfolio. But it doesn't have to be so complex, absolutely not. And what I'm going to try and do today is really distill this down to 4 key steps that I think you need to take as a beginner before you trade. And I think these will really help to get you started on the right path towards making money. Now, I spent 30 years in investment in government bonds, in corporate bonds, equity as well. So I've had loads of experience of doing this, and I started trading in many different types of markets. But I think these are the 4 you really want to have a look at, because I think these will give you the sense of the key steps which will take you forward. So here we go. These are the 4 you need to consider. The first one is going to be finding the right broker. Second is all about learning on the job. It's always tempting to learn on the job and avoid spending too much time preparing yourself. But when you're trading with real money and you yourself are going to bear the real costs of this, I want to put that learning on the job into context and suggest some ways you can be more efficient about it. Another area to consider is going to be market timing. When is the best time to start? And then lastly, let's have a look at whether you should be buying ETFs or whether you should be buying single name stock. And we'll look a bit more about the ETF market. Now, I'd like to start with finding a broker. Now, this is really important because it's actually quite difficult to change brokers at a later stage. If you do decide you want to change brokers, then it means you've got to arrange to transfer your portfolio from one broker to another, and sometimes that's complex. Sometimes you can't even do that, and you may have to sell everything you own with one broker and buy it back with another broker. So in terms of the broker or the platform you're using to place your deals, you really want to get this right from the get-go. Now, of course, you can have more than one broker. If different brokers are giving you a different service and you feel as though you want to have 2, 3 or 4, yes, that's absolutely fine. But bear in mind, brokers will often charge you a monthly or an annual cost. So the more you're using at any one moment in time, the more your costs ratchet up. So my advice is to try and use as few as possible, especially in the early days. And if you're just starting out, if you can manage with one, then I think so much the better. Now, the brokers arrange a whole different panoply of services for you to consider, and you need to decide which type of broker or which type of services are most relevant for you. So some brokers, frankly, the offering they mainly give to you is that they're cheap. And I think that's always very compelling to go for a cheap broker, because I always advise people at the very outset, keep your costs down, because by getting those costs down, every reduction in costs I see as essentially risk-free profit. So going for a cheap broker may very well be a very sensible idea for you. That said, because they have different pricing structures, the broker who is cheap for a large investor with tens or hundreds of thousands to invest may not be the right broker for one who perhaps only has $10,000 to invest. Equally well, some brokers are very cheap if you're putting through lots of trades. Others are much cheaper if you only put through a small number of trades. So it's very important for you to decide whether you think, firstly, you're going to be putting through a lot of trades or a small number. In other words, are you going to be a regular trader or only going to trade a few times a year? And also, are you putting $10,000 into this, or are you putting $100,000 or $1 million? So have a look at their pricing offerings to decide which best suits you. For myself, when I started this, I actually decided I wasn't going to trade very often, and I tended to stick to that because there's a cost to trading. I only trade when I really need to. I try and spend my time doing research instead. So I don't typically look for brokers who are cheap for bulk trades. I'm only looking for those who offer good deals for a small number of trades. But you may want to trade differently, and that's entirely up to you. Now, another thing to consider is the type of product you want to trade. Some brokers, for example, are very good at providing managed funds. They have a whole range they can offer you, and other brokers, on the other hand, have very few managed funds they offer, and they might provide a better service in terms of trading individual shares. Again, you need to think about the type of product you intend to buy. Is it going to be managed funds where someone else is managing the money for you? Is it going to be ETFs where they are perhaps tracking the index? Or are you actually going to drill down and buy a portfolio of individual stocks and shares? Again, only you know the answer to that question, but have a look at what the different brokers are offering, because that range varies enormously. Another thing, of course, you want to consider is not only the range of products, whether it's managed funds or shares, but also the type of shares you can trade. Now, I trade mainly in US equity, so therefore I look for brokers who provide a very good service in the US market. And I want brokers who will be cheap in the US market. I don't buy equity in the UK for a variety of different reasons, but it means that I'm not so concerned about buying cheap UK equity. That doesn't work for me. Now, you may have a totally different approach. You might decide that you're only going to buy UK equity, only European equity, or you're going to buy anything. So have a look at the type of geographies which matter to you. Now, another thing that ties into this is that you need to consider whether the broker will let you keep everything in the currency in which you first bought it. And what I mean by that is, if you're, say, based in the UK and you're buying US equity, you've got to buy dollars to buy the US equity, and the dividends are coming back in dollars. It makes much more sense to keep those dividends in dollars and use them to reinvest, at least if that's your plan, rather than having everything change back automatically into sterling, which will cost you. There'll be an FX charge. And when your dividends have accumulated and you want to buy something else, and if that's in dollars, you've got to pay another FX charge to get it back into dollars. So have a look to see whether the broker will allow you to hold foreign currency dividends in their own currency. If you can, that's another way to get the costs down. And the last point I wanted to raise about different brokers is that you'll need to figure out what type of interface you feel comfortable with. Some of the brokers have quite complex interfaces on the computer, and of course you do want to trade on the computer. To trade by phone is much more expensive, but to trade online, if the interface is complex, how do you feel about that? It may be IT is not your thing, but also the more complex interfaces are usually giving you more information to help you trade. So I think you need to take a view on how comfortable you feel with a complex interface, and also whether they provide you with the mobile coverage. So if you're out and about and you want to trade, you can trade on your phone. Again, some of the phone interfaces are rather more complicated. So those are some of the things which I think are quite key in terms of your choice of broker. One last point as well is that many of them provide you with research. You need to take a view as to whether you think that research is useful to you or not. In general, I don't personally find the research that useful, but that's because I spent many years as a researcher myself, so I can do it myself. But if you think the research is useful, have a look at some of the samples and try and assess whether that's going to add value in terms of your own trading. What I have found very useful myself is where they quote the analyst's recommendations. In other words, where the analysts are bullish or bearish on a stock and the analyst's target prices. This is always, I find, very, very helpful. And if you can find a broker who delivers you that, personally, I would always be inclined to have one who does so. So before you start trading, figure out who do you want as your platform, your broker, in other words. So who you're going to trade with, because I think that will shape your experience and it'll shape how much money you make as well. And remember, it's not that easy to change broker at a later stage. It's possible, of course, but it's not straightforward and it's not something you necessarily want to get involved with. The second thing that I certainly thought about first before I even traded anything was, how was I going to learn? Because it's always worthwhile figuring out what's the on-the-job learning going to be. And certainly most jobs you take on, professional careers, you spend a certain amount of time amassing qualifications beforehand and amassing information, and then when you've got it, when you're actually on the job, that's when some of the real learning begins. It's just the same when you're learning to drive. You take a theoretical test first. You only get the experience when you're actually driving the car. You need to strike that balance. Make sure you have enough information available to you about how equities work, the sectors available to you, the products you can buy, before you push that buy or sell button. Now, I produced a course which will go through in some detail much of what you need to know before you make that first trade in the equity market. And I'll put a link to the course at the end of this video. But then there is also the learning you do on the job. And this is where potentially things can get very expensive and unnerving. Because what you don't want to do is, by learning on the job, you lose a lot of money. So, and I give this advice to everyone I meet, when you first start trading, paper trade. In other words, don't put on real trades. Just log what you would have done on a spreadsheet. In other words, the price at which you would have bought, and when you decide you want to sell, log the sell price, log the dividends you got in the middle, and figure out what your return on each of your positions is. And over time, see how much money you've made or lost over 1 month, 3 months, 6 months, and so on. It's really important that you build confidence in yourself so that you understand whether you're a good trader and you know what you're doing, or if you keep on losing money, then maybe this isn't something you want to do. So try this first in a very safe space by what we call paper trading. One of the other reasons why this certainly helps you is that if you've made quite a bit of money paper trading, or make-believe money, but it's paper trading, and then your first real trade goes wrong, that's not going to undermine your self-confidence and make you feel as though I'm never going to touch this again. On the contrary, you'll know you've been very profitable so far. Some trades will go wrong, it's one of those things, and you'll have the confidence to go on forward and put on more real-life trades. But I do advise you, be risk-averse, do test yourself beforehand, and where you've made money, look at why you've made money, and if you've lost money, look at why you've lost money. In other words, if you put on a position and you lost 10% on that position, was that because the equity market just went down 10% and that position was no worse or no better than anything else? But if the equity market had actually gone up over that time, you might think, well, how did I manage to lose 10%? That was a really bad trade I put on. I clearly bought the wrong company. So look at the context surrounding what the market did at that time and whether you were likely to have made money or lost it at that time. So it's not just about the numbers. Qualitatively, look at your decision-making process. Why did I buy it? When I sold it, why did I sell it? What happened in the medium term over that between the buy and the sell? And therefore try and understand in context whether you've done the right thing or not. Of course, not every trade is going to work out, but you want to make sure that over a long period of time, the majority of your trades are making money, and that's really going to perform. So we're going to leave it there for today. Coming up in part 2, we'll be exploring 2 issues in more depth. The first issue is going to be about market timing, how to know when to buy and when to sell. And the second is, should you be buying ETFs or single name stocks or both? How do you decide? Look forward to seeing you then.